What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and we got a heavyweight tilt on our hands, folks, today in two juggernauts in Microsoft and Meta. What we'll be doing today is looking at the company's fundamentals and their technicals to see how they stack up on a valuation basis. Now, before we dive in, I do just want to mention that this video is not investment or financial advice and is solely for entertainment purposes. All values that you will see within this video are as of market close on March 27th, 2026. So what we got here in front of us first is the last 12-month price chart for Microsoft. Now, folks, you can see the total return in that time frame is negative 8%, a peak to trough decline of almost 35%. You'll see two lines on this graph here. One is the green line, which is your 50-day moving average, and an orange line, which is your 200-day moving average. Now you can see that shares are trading well below both moving averages and have produced a negative return for shareholders over the past year. There are a few key items I want to point your attention to. And first, we'll start with the bottom left side of the page here. There are 34 analysts that are covering Microsoft, and they have an average price target of $587.77. Now, from where shares are trading on market close of 356.77, that does imply an almost 65% return in that time frame. Not bad for such a large company. Now, Microsoft does pay a dividend. Now, we're not buying Microsoft for the dividend. It does pay an annualized dividend yield of 1% or $3.64 per year. A nice boost, a nice incentive to have while holding the shares. But we want that share price appreciation. Now, the fundamentals of Microsoft are looking good. You can see in the bottom right the sales numbers over the past 12 months of 16.7% sales growth. The industry average of 10.6 and the benchmark is 6.6% sales growth. For a company as large and as mature as Microsoft, to have those double-digit sales growth year over year is looking very good. Now you look at their gross margins, they do have a 68.6% gross margin profitability. That is above the industry average of 49.5% and well above the benchmark of 27.7%. Now, Microsoft does have fixed costs, overhead, and is spending CapEx intensively in their data center and AI infrastructure build-out. So you do see those net margins come down, still very good at 39%, more than double the industry average at 16.8%, and well above the benchmark at 8.4%. So a company that is a cash juggernaut still delivering returns to shareholders in their underlying business. Now, when we look at the valuation, you'll see there the PE of the last 12 months or the trailing PE, depending on what site you look at, is a 22.3. The next 12-month PE or the forward PE is a nice 19.4. That is value territory, folks. That is no longer a growth company, but the underlying fundamentals are growing phenomenally for Microsoft. Now, another value I want to draw your attention to is the RSI, the Relative Strength Index. Now, you can use parameters between 30 and 70, or 80 and 20, 70 and above being overbought, and 30 and below being oversold. Now, Microsoft is on RSI of 21.5, which is very much oversold. Now, why is that oversold? Well, there's a few reasons. One, in their most recent quarterly report, Microsoft did report their Azure, their cloud business, has slowed down. But that slowdown is not from a lack of demand, but actually from supply constraints. To the extent that Microsoft has reportedly diverted some of its own data center server capacity to its internal AI development, which means, folks, that there is less immediate capacity to sell to external enterprise clients. Obviously, that will shrink your revenue. So if they do get their act together in terms of having their supply chains rebalanced and fixed, they can have and supply that demand for the Azure services. Now, Microsoft, like every other tech company, is spending massively on its data center and AI build-out. I will point out, though, that Microsoft's CapEx is not at the same extent as other tech plays. Now, there is some worries that Microsoft 365 Copilot is being slowly integrated and adopted by large enterprises which are clients of Microsoft. Now, that is a problem because investors want to justify the capex spending, and if the demand isn't there and the adoption is slow, we do stretch out returns, which do draw down and cause re-ratings in share prices like we see right now. But on a technical basis, we can see that Microsoft is significantly trading as a value name. Next, I want to draw your attention to Meta, and even more of a decline in the past 12 months. You can see that a total decline of negative almost 13% over the past 12 months, a peak to trough decline as well of almost 35%. Now you can see a lot of that is on the right hand side of the chart. That is because of some litigation costs that we're living through in real time, which is causing a re-rating in the company. You can also see that shares are trading well below the 50 and 200-day moving average, so technicals are looking attractive for new entry for money. Now, we have 63 analysts that are covering Meta, almost double the amount of Microsoft's coverage. In that, 63 analysts have an average price target of $860.47. So from where shares are trading on March 27th of 525.72, that does imply a 63.7% return. Amazing returns, folks. We're talking 60+% returns for such large, well-known household names. You should really take a look at these here. And I do just want to mention that price targets aren't always accurate, but for an average of 63 analysts to have a 63% implied return is just giving investors confidence to dive into their name or at least dip their toes in the water. Wow. And you look at that sales growth there on Meta, that's more than Microsoft's at 22.2% sales growth year over year. And it more than double the industry at 11.2, and obviously much higher than the benchmarks at 6.6. For such a large company to have 20+% sales growth year over year is very good. Gross margins of 82%, very good. But you can see from that gross margin to net margin, Meta does have overhead costs that are always going to be there, but they are spending heavily on capex. So you do see that gross margin go from 82% to 30.1, better than the industry and still much better than the benchmark. In terms of technicals, the trailing PE of 22.4 and the forward PE of 17 is screaming value for Meta shares. Now, the RSI is even lower than Microsoft's, which was 21. Now you're looking at Meta's at 17.22. Oversold no matter which parameter you use of the 2080 or the 3070. Good time to probably take a look at the name, especially if the technicals are really showing value there. The reason that I mentioned before that you saw a lot of that decline on the right hand side of the share chart is because of jury verdicts in California and New Mexico. Now investors are going to have to potentially account for future litigation, which causes a re-rating in the stock price. And yet these two jury verdicts did amount to a combined total of $380 million. But for a size company like Meta, that is a drop in the bucket. Still large numbers, but minuscule in Meta's size. Now the capex that I mentioned that you can see in that gross to net margin differential, 72 billion of spending in 2025, more than doubling that in 2026 and beyond of 115 to 135 billion dollars. I will say that Meta's management does have a great track record of delivering a return on investment when it does have these capex spending sprees. Now, there's also the geopolitical issues in the Middle East where fundamentals don't matter, so there's sell everything trade, and there is a little bit of fog, and investors don't like that fog in the metaverse, whether they're going to keep it running or taking it out indefinitely. I think it'll be a good idea for them to transfer some of that server and data capacity to save a little bit on that capex and reuse some of those resources. But multiples are showing that it is the lowest it's traded at, or one of the lowest times it's traded at in the company's history. That is all, folks. I do just want to mention if you can hit the like and subscribe button, would mean tremendously, mean amazing things to me. And I will mention that you can drop a comment down below, and I'll be more than happy to analyze any company. Just leave the ticker symbol in the comments, and in one of the future videos, I'll be more than happy to analyze and post that for you folks. Thank you so much. It's your boy, the Finance Bro, and we're calling out.